Hello and welcome to today's extensive weekend video, which will be short but extensive because it's rich in charts and actual macroeconomic data and what they mean for markets as we go. It's called inflation. It's about inflation reaction within several markets. You thought that precious metals would be rising on quickening inflation pace, be it CPI or PPI. No, forget it. And trading signals clients have been benefiting on those calls just as much as I called for oil to swing high towards the end of the week. However, not to overstay what is welcome, because it would drift lower, which is exactly what had happened. And we saw those gyrations, that indecision, as well in the US dollar, which had surged higher following really high PPI. It's as if the Fed were to tighten or keep tight, meaning not cut September, do not cut October perhaps. Those odds went meaningfully up, and the jump of almost 10% in Fed Watch 2 odds for September there being no cut is very meaningful. Yet markets had made up their mind Friday that it's full steam ahead, you would cut anyway, and in the Joe mandate the argumentation about weakening job market would prevail. So let's put all the pieces of the puzzle together within yields and individual sectors. We can see that yields, however, have not been exactly buying that calm interpretation of rate cuts to come, and they had not been able to lift the dollar up. Part of the explanation could be that the tariffs, while out of the limelight, those tariff wars are not over, not at all over. And when it comes to inflation, it's not just about the tariff impact. What is more worrying is that the services part of inflation is quickening. It's quickening too. And when it comes to tariffs, and initially in April, way too many trading partners, notably Japanese car makers, had kind of rolled over and sucked it up by dropping prices to make up for those newly levied tariffs. That kind of readiness to absorb those costs is waning, and as the shelves and as the warehouses fly emptier and emptier by the day, they would be restocked at higher prices, because also Japanese car makers had second thoughts about dropping their prices and moved them back towards the pre-tariffs, pre-liberation day levels. So that definitely paints quite a picture, and especially the day before PPI, when I was cautioning clients about beware, high PPI equals eating into corporate profitability, and would you say that equities are not trading at rich valuations already? What would it do to the favorite Wall Street metric of forward-looking earnings? Bingo! It means that while stocks are trending up, those tail risks are present, and we will dive into intraday charts as well, examining that, how I had been navigating things throughout this week and what it means for the days ahead. But you can see here in yields the reluctance in these to retreat further, and the fact that it does precisely nothing to support the dollar. Here we go with the hourly chart of S&P 500, and on a Wednesday the key development that I have been mentioning was that prices had refused to cut into CPI range of the preceding day, and they had found a comfortable support. And for all the vulnerabilities, for all the non-confirmations, be it in breadth, be it in several meaningful oscillators, these have not broken to the downside. The same story was present on Thursday. I was ready to short. However, on a swing term basis, it was not possible to make that call with a clear conscience. Absolutely not, because as we have seen Friday, stocks have headed higher, and we will be diving as well into closing price action. Those candlesticks represent heavily NVIDIA weighted semiconductors index, and what I have been talking about is the communications leadership and the still quite defensive sectoral overview when it comes to the stock market. And what's as well notable is the on a longer time series, meaning these 5 to 6 trading days, the financials performance is positively suspect. So this gives you as much as you need to know. And on Friday, the power hour did not bring any buying frenzy, as I had told clients it would not bring one. And those pieces of the puzzle were put correctly together, and we had seen no real advance in S&P 500, just immense sturdiness in it not breaking down meaningfully. So where was the profitable pocket of weekly calls, weekly income to be made? It was in Russell 2000, and specifically in shorting that, because it was the slam dunk trade to be made, to be calling for, as I had been saying that this is at least temporarily, at least somewhat introducing uncertainty as to September rate cut, and even speculation that Powell on Jackson Hole, which is rapidly approaching, would just announce no rate cuts and focus on inflation. Think whatever you want about that proposition, but this is what is seriously or clickbaitishly, have your pick, being discussed in the financial universe. I have my opinion about that, whether he is in a position to refrain from cutting in September or not really, or perhaps introduce more uncertainty as to future FOMC meetings. Here we go. The chart-rich part of today's video starts with semiconductors, heavily NVIDIA weighted one, heavily NVIDIA weighted ETF, SMH, and we can see that it's weakening, still pushing higher, and my expectations as to NVIDIA earnings and what it means for even some second tier bit cultish stocks such as AMD, what it means for them, it must be said in a positive way, what it means when I talk about earnings positioning and actual earnings to come versus what the market expects them to be. IGV is perhaps at least as important as SMH. However, we are seeing quite a wave of weakness, and it's quite nicely showing in Nasdaq performance. And this is the ecosystem that feeds off whatever is the semiconductors one able to achieve, and unfortunately this is not having the greatest of traction, which is a message to listen to very carefully in itself, and it's part of the larger case for S&P 500 and Nasdaq itself that I'm presenting. Just as we have had the PPI run away from tech, run away from Russell 2000 relatively in favor of tech. We have seen this a bit getting second thoughts on Friday. Financials, the chart is looking quite good. However, this strong and engulfing at the end of the week has to be respected, and it has a bit to do with what I had been telling you about inflation, but as well about University of Michigan consumer inflation expectations. What consumer discretionary staples do not show yet. Consumer is expecting stronger inflation down the road than was the case a month ago. Regional banks are reflecting that even better than financials themselves. This well justified caution in the stock market that would be giving headaches to impatient swing traders, be it long, be it short. Here we go with biotech rallying as if it were no tomorrow, as if those rate cuts were secured. Message to remember: home builders, kind of same story. I would not be totally afraid of this daily candle, especially after such a strong run. Materials, I had talked positively more than a couple of days ago, well over 7 days ago, about this sector and how it is going to start to lead S&P 500, which it did. However, let's have this one in mind when evaluating broader strength within S&P 500, just as much as we should be looking at industrials and what the dollar itself is doing. On a one-day basis, you do not want to see tech retreating that badly and taking with it as well utilities and industrials, especially considering what the dollar is doing. Financials, it has been this is a picture of a strong risk of day. Very resilient discretionaries in this context, isn't it? So, and we are seeing some kind of risk of positioning, risk of inflows into healthcare and real estate. And real estate had not been the shining star. The shining star of defensive interest rate cut plays had been really home builders and biotech. On a 5-day basis, the picture is approximately as clear, and it as well points out that the market conviction about rate cuts. Market is simply convinced. Think of it as more people being positioned towards one side of the boat and not being enough afraid of Powell not willing to cut, or not willing to cut enough, or to present a hawkish cut, however you want to call it. That's a strong message in itself, and discretionaries thus far are quite undaunted. However, something is going on with healthcare. I had been already talking materials, how they are recovering, and frankly the performance of industrials is disappointing just as much as tech and utilities. So, and lackluster financials, I had already discussed this as through the KRE optics, so this is definitely something to pay close attention to. So, what do we have ahead? I'm pretty aware that you have not been able to witness all too much of what I'm doing premium for clients, because I had redrawn the balance and I had cautioned you towards the start of the week what to be ready for, and it is there where the meat and potatoes are being served. So, once again, your call. If you care about quality, timeliness, and accuracy, you should be joining.